Warning, this legendary investor makes a massive and a very strange bet. Now, in the investing world, there's legends. We got the Warren Buffetts, the Ray Dalios, the Stanley Druckenmillers, who have amassed fortunes and made huge names for themselves in the investing and the stock market world. But there's another investor who's larger than life. His legend has leapt past the investment world and into mainstream culture. And he's done that by betting against the crowd, by making crazy bets that nobody else sees but him, and it's made him a fortune in doing so. Now, I've always said that my secret to success is copying other people's successful secrets. What are they doing that's successful? If I do the same thing, I should have about the same results. And so I like to understand what they're doing so I could take those secrets, those breadcrumbs, and apply them in my own life. So in this video, we're going to look at this legendary investor. I'm going to show you what his recent filings show us about what he's doing. And it is a crazy but a massive bet. We're going to look at it, why he did this, break it down, and see if it's maybe something we should follow. So let's go. All right, welcome back to my Awakened Lions. I say that because you are the ones that have seen it, you've heard it, you're awake, and you're here trying to improve your life and the lives of others around you, so congratulations. We are going to make it. There's plenty of doom and gloom out there, but as long as we're aware of it and we move and pivot in time, we are going to benefit from that chaos. Now today, let's dive in real quick. We're just gonna jump right into it. The ultimate contrarian, the ultimate. I mean, this guy right here, I'm talking about Michael Burry, went and made the biggest contrarian bet and was ahead of everybody else and made a fortune doing it. It was an outsized bet on the mortgage meltdown. Now, the great financial crash, in hindsight, who couldn't have seen it coming? Of course, the housing market was going to crash in 2008, but he saw it coming much, much earlier. As a matter of fact, he was one of the first people, if you watch the movie The Big Short, then you already know the story. But he saw that there was bad lending going on. He saw that these mortgage companies were getting way too greedy. They were packaging up all these things into sausages, these mortgage-backed securities, getting rid of all the risk profile, packaging them up and reselling it. Greed was running way too high. There was way too much credit in the system, and he knew it could not last and it was going to crash. So he bet on it crashing. Now, he made over $800 million, about $1 billion for that contrarian bet. That was really good. Imagine making almost $1 billion, about like George Soros made about $1 billion in a single day by breaking the Bank of England. So about the same level of notoriety. Now, he entered his position in 2005. Now, this was a little bit too early. As a matter of fact, it was way too early. And as the saying goes, being early is the same as being wrong, especially when you're going short because you're having to borrow. And if you've watched the movie, then you know how hard it was for him to stay in that position when everyone was trying to get him out of it, but he did. But the reason why I bring this up real quickly is because he's recently been also shorting debt-dependent companies like Tesla. So he's been trying to do this over and over, and he hasn't had the best luck. So he doesn't win every single position that he puts himself into. Of course, nobody does. But let's take a look at what we're talking about. So if he saw bad debt in 2008, he could sniff it out in 2005. He knew it was coming. He saw the problems. Then what does he see today? What is he sniffing? What problems is he seeing? And then, of course, what conclusions is he drawing from that to show him what should be invested into? It's one thing to see the problem. It's a whole other thing to understand what's causing the problem. And then it's even another to know how to take action based off of those two variables that you've seen. And that's exactly what we're going to understand about Michael Burry. Okay, his new contrarian bet. I'm not going to wait till the end. I'm going to give it to you right now. Then we'll break down what he's seen. And typically I'd say this to the end. I'm just going to give it to you right now. If you like that, give me a thumbs up on this video. That way I'll know and I'll start trying to bring them a little bit faster. Of course, while you're at it, hit that subscribe button and the bell notification if you like me bringing this forward. Okay, so the new contrarian bet, what is it? Well, first of all, Michael Burry's firm is called Scion Management, and he has only one position open, only one in a hedge fund. Now, we have the benefit because these hedge funds, they have to put out their public information. And so what we can see, Michael Burry in California, we have the date, we can see all the filings of what his hedge fund is buying and selling. And like I said, they have only one position left. And not only do they only have one position left, but it's a hedge fund. A hedge fund gets its name because it's always hedging its bet. It's long and it's short. It's hedging its position. His hedge fund is not hedging. They're not hedging. So what is it? Well, they bought this company right here. It's called GEO Group. Now, it's been up and down. This goes all the way back to 1995. We can see it's come all the way up. It peaked right here about 2016, 2017, a massive peak at about $34 a share. And right now, it's what we would call historically cheap. Remember, when it comes to assets, we don't know when their tops and bottoms are. Nobody in the world knows tops and bottoms. It's impossible to predict that until we look backwards on it. Like, for example, you might have thought this was the top, right? And looking backwards from here, it was the top, but here it got even higher. So we only know the tops and bottoms until we get back. So what we do is we look for when they're cheap or expensive. And what we can see is this is historically cheap right now. So what is GEO Group and why is he buying it? But more importantly, why is it his only one position without even having a hedge? Well, let's take a look at that. What we can see here is save for a single solitary bet on a company that profits the more often the government puts people behind bars. Wait a minute. So the company he bought makes money when the government locks people up? Every other position he has was liquidated at the end of June. So what kind of company am I talking about? Well, I am talking about GEO Corp, which is or GEO Group, I should say. It's a publicly traded C corporation that invests in private prisons and mental health facilities in North America, Australia, South Africa, and the UK. So the company that he's put all his hedge fund into is a company that makes money when more people go to prison. Now, why the heck would he invest into that? Does he think that the prison populations are going to explode? Well, let's see what data he's looking at. All right, consumer debt levels, let's just say they're really bad. Consumer debt levels are at all-time highs. As a matter of fact, I have a couple charts that I want to show you, of course. This is the revolving consumer credit owned and securitized. So revolving credit. This is consumer credit. It's not good credit. It's not credit like on homes that actually are worth something. And what we can see is that the amount of credit has just absolutely ballooned. Here's the 2008 great financial crash. And of course, it came down after that, and now we are making new all-time highs in revolving credit. Remember, this is not good credit. This is what we would consider bad credit. Good credit, just for you Rich Dad, Poor Dad, Robert Kiyosaki fans, good credit is credit that would make you money. So if I bought a rental property, I borrow money to make the rental property, and that rental property makes me money. That's good credit. Bad credit is when you buy food on your credit card, all right? And that's what we're talking about. Here we have consumer loans. These are credit cards and other revolving plans for all commercial banks. And you can see like we're trending up, but not too bad, not too bad. Here we have 2010 through the roof, and now look how high we are. Again, all-time highs. And then this is the opposite. When we have credit, personal credit going through the roof, this is personal savings rate. This is the amount of money, if you will, a life battery, how much people can live on. And what we can see, maybe I made this chart a little bit too big. What we can see is that personal savings has just kind of been pretty flat. People don't typically save a lot of money. Of course, it's so expensive in this world, how can you? But we can see personal savings shot up. Nobody wanted to spend money during the pandemic. Everyone's afraid the world was gonna collapse, but then they spent it all. And look how fast that has come down. Remember, we always look at the charts because we want to see the size of the move and also the speed. It'd be one thing if we saw it go down like this, but we're seeing it go straight down like that. That is a very important move for us to understand. All right, now the other thing is, of course, if you watch my channel on a regular basis, you know I'm always talking about cycles and history. It doesn't always repeat, but it always rhymes. Cycles, repeat, repeat, repeat. Credit is no different. We have a credit cycle. We have the business market cycle. Credit expands, and then it contracts. And then it expands, and then it contracts. And it expands and contracts. What happens is, basically, I have a chart here to show you. So we have the key interest rate that the Federal Reserve sets, the Fed funds rate. And what they do is when they raise interest rates, it makes borrowing more expensive, so less people borrow. Less money is created. Then, when the market stalls out, they lower rates, which makes borrowing very cheap. So then people go buy more houses and more cars, which then creates a lot more money through debt expansion. And then when it dries up, or when it gets going too fast, too much inflation, they raise the rates again, and they drop them. So you can see the Fed just keeps raising and lowering rates, increasing the money supply, decreasing the money supply, increasing, decreasing. Now, one thing to keep in mind here is you can see each one of these like little steps right here. And this is each time they've raised the rates. what we're witnessing right here is an almost vertical move. Notice there's no steps within that chart. Remember, we look at the charts because we want to see the size and depth of the move, and we can see that. And so when they raise key interest rates like this, then it makes it harder to get business loans and equipment and houses and all those things, and things stall out. All right, another really bad sign of the times is when you start seeing like this, Uber Eats. As a matter of fact, I had Uber Eats today, but I didn't use a buy now, pay later feature. If you're having to pay later for the meal you're consuming today, it's probably not a good sign. Now, I get it. Some people are in bad situations. Some people are in emergency situations. But I'd still probably rather go to the grocery store and get some really cheap food and try to live off of that rather than trying to rack this up. But when you have payment plans for Uber Eats, it's not a good sign. When you have 0% APR for 60 months on furniture, it's probably not a good sign. You may not need that new bed, or you may not need that new couch right now. You might just want to wait until you could actually afford it. And these are the signs that Michael Burry is seeing. All right, now I talk about all the time when a nation gets to a certain threshold of debt, typically over 125% of debt to GDP, there's really only 4 ways out, one of which is austerity. That means, reducing your spending, living on a budget. Who wants to do that? Well, no government with unlimited printing wants to do that, and no one when money is free wants to do that either. Why would I punish myself and live on a budget when I have unlimited money? And so what we see is that people and businesses have been borrowing frantically because money's basically been free for 14 years. When I say basically free, 2%, 3% interest, 0 down for 60 months, that is basically free money. And so if there's free money, then I'm going to take as much of it as I can. Cheap borrowing leads to no austerity. Why would I go on a budget? I can replace my whole living room and I don't have to pay for 5 years. Sure, why not? Oh, I can go out, I can get Uber Eats and I don't have to pay for it. Sure, why not? And you can see how taking on that debt leads to this poor austerity. When borrowed money isn't used productively, it can't be paid back to pay down the principal. This goes back to the good and the bad credit as I was talking about. So that's what exacerbates that situation. Now, once we have all this debt that's built up in the system, everyone's bought their furniture and their Uber Eats and they haven't paid for it, consumer loans are high, there's no savings left, what happens? What's the inevitable outcome of that? Now, maybe it takes a long time, but what's the inevitable outcome? That's what Michael Burry is betting on, just like he did in the 2008 Great Financial Crash. Early, but he was right. Now, what happens is that one person can't service their debt, they default on their debt liability. All right, so my business is expanding, I'm in the construction business, I need to hire more crews, I go and I finance 3 vehicles, I get more crews working, but as soon as construction rolls over, I can't service the debt, and now the debt servicing on those 3 vehicles, up in smoke, it's gone just like that. But then the lender's debt asset also appears. So what happens is I have 3 trucks that I owe debt on. The lender, on their books, they have an asset. My loan is an asset. But when I default on my loan, their asset disappears. But then their debt to somebody else is an asset that disappears. And the domino starts to go down. Liquidity basically vaporizes from existence because of this deleveraging. Let me give you a practical example. If I had a candy bar, I had a Snickers bar, and I gave it to this person, and they gave me an IOU. So now they owe me a Snickers bar. I don't have it, they have it. But then they give it to person 3, and they get an IOU. So now person 3 has the Snickers, person 2 is owed one, and me, person 1, is owed one. And then person 3 gives it to person 4, and then person 5. So now person 5 actually has the candy bar. 4 is owed a candy bar, 3 is owed a candy bar, 2 is owed a candy bar, I'm owed a candy bar, right? So now there's 5 candy bars, but really there's only still 1. And then what happens if person 5 eats that candy bar? Now that candy bar is gone, but actually all the candy bars disappear out of the system instantly. Does that make sense? That's how that works. And you can see this through a historical lens right here. So what we can see, this is government total public debt GDP ratio. So we have all the way back to 1920, the Great Depression, after World War I. So we took on massive amounts of debt and we're able to deleverage it down. Then into World War II, massive amounts of debt, and it was able to deleverage back down. And then we have the 2008 great financial crash. And now here we are again back to these levels above where we were in World War II. Of course, I made plenty of videos of exactly how this plays out. We'll go ahead and link to that video up here if you want to watch that. We'll put it on the end screen as well. And we can go back to a tweet from Michael Burry, and I think this chart really sums it up nicely here. All right, ever wonder why doomsday scenarios so rarely come true in your life? So the sky is falling, right? You got the Harry Dents, you got the Peter Schiffs. They've been telling you this whole system is going to collapse for a long time. All these people saying doomsday scenarios, but why does it never come true in your lifetime, he says, on this earth? Well, the reason why is because debt. They can keep the patient alive on life support by injecting debt. But the problem is, eventually, it stops working. The law of diminishing returns. Eventually, it stops working. And so what we have right here, this is the green line of debt. All right. So what we can see, GDP. So we can see GDP going down. We can see the white line, GDP over total U.S. public debt, going down. And then the yellow line right here is debt alone. So what we have is we have GDP coming down and we have debt going up. So as these lines cross, this going down, this going up, we've now entered the point of diminishing returns. And as this continues to get chased down, it eventually ends. So all the people predicting doomsday here and here and here and here, they're all right. They were all right. They are all right. The only thing they're wrong about is the timing. Just like Michael Burry was wrong on the timing for a couple years before he made the big bet, or before he won the big bet, I should say. All right, betting on too much unservable debt leading to a deflationary bust. Again, that's what he is betting on. Now, what happens when we have a massive bust? Well, most likely civil unrest. You see it happening all over the world right now, right? Just today I saw Pakistan. Obviously we got Sri Lanka, we got Lebanon, we got Peru, we got Ecuador. You name it. There's about 10 countries with people protesting like crazy. Even China has tanks in front of the banks protecting them. So what happens? We have massive civil unrest. What happens with massive civil unrest? Massive people getting arrested, maybe? What else do we have? When a nation starts collapsing like this, they start losing money. What else do? They try to start squeezing all the money out of the taxpayers. As a matter of fact, let's go back to this old cartoon from when I was a kid. I played a clip in one of my other videos of the day. Here's another clip of, to illustrate this. Let's go ahead and watch that clip.
Let me give you a hand with that leg. Ups-a-daisy. Bingo. Think up next. It smarts, don't it, Otto? But Prince John says that taxes should hurt you.
Can't you see the tears we're crying? Can't there be some happiness for me?
So what a nation wants to do is they want to squeeze the money out of you, which is why the IRS just hired 87,000 new agents. They increased their budget by 12 times to come after you. Their agents are now armed and are able to use deadly force. And what are they going to be doing? Half of the money that they got, the IRS got, $45 billion, is for enforcement. If they enforce a penalty on you, what does that do? Then they can take you to jail. Are you starting to see what happens? As the system collapses, the IRS is putting people in jail, civil unrest is putting people in jail. And Michael Burry expects jails to do pretty dang good. It's his only bet left. Now, is this too early? That's the question. Let's play this clip from Michael Burry from the movie The Big Short right here.
Watch, it will pay. I may have been early, but I'm not wrong.
It's the same thing. It's the same thing, Mike.
So, you see it. If you haven't watched the movie, you should. But they're like, hey, you're wrong, you're wrong, you're wrong. He's like, I'm not wrong, I'm not wrong. I'm just early. So, is it too early? He's betting on this deflationary bust to happen. Will it happen in the next couple of months? Will it happen in a couple of years? How long is he prepared to wait? I don't know. Will it pay off? Eventually it will. There's only one way out. There's only one way out. The question is, can he wait long enough? And we'll find out. Let me know what you think in the comments down below. Do you think he is right? Or is he just early? Put right or early down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't, that's okay, give me a thumbs down, but at least leave me a comment, tell me why. Hit that subscribe button while you're at it. And before you leave the page, watch this other video right here.